Hey everyone, and welcome to this explainer. Okay, so what if I told you that successful stock investing isn't actually about finding that one magical stock that's going to double overnight? The stuff you see all over social media. It's really not. And honestly, it's not about glaring at the market every single minute of the day either. Today, we're going to cut right through all that noise and build a genuinely powerful long-term strategy. So what if successful investing isn't about doubling your money overnight? I know, that completely goes against everything the hype machine teaches us, right? We literally constantly see influencers pushing the latest hot tip. But the truth? Real, successful investing is mostly just about discipline, patience, risk management, and making good decisions consistently over a long period of time. So whether you're literally just opening your first brokerage account today, or you've been investing for years, we're going to walk through 5 incredibly powerful rules to help you build a much stronger strategy. All right, here is our roadmap. We're going to start with the reality of investing, and then we'll dive right into our core rules. So that's investing for the long term, diversifying your investment portfolio, making sure you actually understand what you buy, controlling your investing emotions, and finally, consistent investing and risk management. Starting off with Section 1, the reality of investing. The absolute foundational concept here is just making sensible decisions repeatedly, rather than, frantic day trading.
Which brings us right to rule number 1, invest for the long term, giving your money the time it needs to actually grow over the years.
Look, one of the biggest mistakes new investors make is expecting the stock market to make them rich by next month. You buy a stock today, cross your fingers, and just hope it doubles. But honestly, that is simply not how it works. The true engine of building wealth is compound growth. Basically, imagine you invest consistently, right? Your investments generate returns. Well, over an extended period of time, those returns actually start generating their own additional returns. The longer you just stay invested, the more time compounding has to do the heavy lifting for you. It's literally like a snowball rolling down a hill, gathering more and more momentum.
But hey, we need a quick reality check here. The market is not going to go up every day. Actually, scratch that. It absolutely will not go up every day. There will be corrections. There are going to be crashes. You will, for sure, experience periods where your portfolio is down 10, 20, maybe even more percent. And you know what? That's completely normal. It's just part of the deal. The fatal mistake is letting that short-term panic completely destroy your long-term plan.
So we need a major mindset shift here. We have to stop asking, okay, how much money can I make this month? And start asking, where could my investments be in 5, 10, or even 20 years from now? When you adopt that long-term horizon, it really helps you avoid those super emotional decisions and stops you from making frantic, unnecessary trades. Moving right along to Section 3, diversify your investment portfolio. This is all about reducing your concentration risk. In the simplest terms possible, please do not put all your eggs in one basket. Imagine putting your entire net worth into just one single company. Okay, sure, things look great at first. Shares go up, you're making money, but then, out of nowhere, they lose a massive contract, or maybe management makes a huge mistake, or the whole industry takes a hit. Boom, your entire portfolio tanks. So, what should a diversified portfolio actually look like? Well, you want to spread your investments across different sectors of the economy. Think technology, financials, healthcare, consumer companies, and property. The whole shebang. By spreading it out, you drastically lower the chance of one bad investment completely wiping out your net worth. Now, I know what you might be thinking. Researching dozens of individual stocks sounds absolutely exhausting. Well, good news, you don't actually have to do that. Broad market ETFs and index funds are kind of a game changer here. They can give you exposure to hundreds of companies across all those different sectors just through one single investment. It's so easy. Keep in mind, diversification doesn't magically eliminate all risk, but it definitely prevents one single failure from destroying your financial future. Okay, on to Section 4, understand what you buy. Basically, doing your own research. I know. This rule sounds incredibly obvious, right? But it's honestly shocking how many people completely ignore it. You hear some guy on social media screaming that a stock is going to the moon, fear of missing out kicks in, and suddenly you're throwing your hard-earned money at a business you literally know nothing about. Okay, let's pump the brakes. Before you buy any stock, you need to run through a quick, rapid-fire checklist. What does the company actually do? How do they make money? Is their revenue growing? Are they even profitable yet? How much debt are they sitting on? And what's their competitive advantage? You absolutely don't have to be a Wall Street analyst, but you definitely need to understand the basic fundamentals of where your money is going. And really, this is the golden rule for this whole topic. If you cannot explain your investment thesis in simple, everyday language, You probably just don't understand it well enough. Seriously, never buy a stock just because some random person on YouTube, TikTok, Facebook, or X told you to. You've got to do your own homework and know exactly why you believe that company will still be thriving years down the road. Which flows perfectly into Section 5, Control Your Investing Emotions. We've got to avoid fear and greed. I'll be totally honest with you, managing human emotion is without a doubt one of the absolute hardest parts of investing. You have to watch out for that dangerous emotional pendulum. The stock market has this funny way of making you feel like an absolute genius when prices are going up, and then incredibly stupid when they drop. Think about it. A rising market hits, greed takes over. You feel brilliant, and you get this massive urge to just buy more before prices go any higher. But then the market crashes, and fear totally replaces that greed. Suddenly, the exact same investor who was happily buying at the very top feels panicked and wants to sell everything at the absolute bottom. It's the classic worst-case trap, buying high and selling low. So how do we break that cycle? Well, you have to establish a clear plan before things get stressful. Remember why you bought the investment in the first place. Know exactly what your time horizon is, and be super honest with yourself about your risk tolerance. That way, when prices inevitably take a dip, you can look at your plan and ask, okay, is this just normal market noise, or did the actual fundamental reason I bought this company change? Do not let fear and greed drive the bus. All right, let's look at our sixth and final section, consistent investing and risk. It's time to protect your downside. Here's a secret. You really don't need a massive pile of cash to get started. What you do need is consistency. The absolute best move here is to invest a fixed amount regularly, like setting up an automatic monthly contribution. That strategy completely beats the impossible task of trying to perfectly time the market. Seriously, waiting around for the perfect moment to jump in usually just means you're stuck sitting on the sidelines forever. Getting into the habit of regular investing keeps you moving forward, totally ignoring whatever crazy noise the market is making on any given day. But wait, hold on a second. Investing actually shouldn't be the very first step in your financial journey. Before you put a single dollar into the market, you need to make sure you have an emergency fund set up. You need to pay off any crazy expensive debt you might have. And please, never, ever invest money you're going to need for short-term essentials. Your absolute number one job in the market isn't actually getting rich right away. It's protecting your capital and managing your risk so you don't do permanent damage to your finances. Get that sorted, and then you can give your investments the time they need to truly grow. As we wrap up this explainer, I really want to leave you with this ultimate bonus rule. Successful investing is not about predicting the future perfectly. It's about making sensible decisions repeatedly. You hit the nail on the head right there. You don't have to win every single time. You just need a reasonable, solid strategy. Invest for the long term, diversify, actually understand what you're buying, keep your emotions in check, and manage your risk. Making those good decisions over and over again is exactly what gives you the power to reach your goals. So, I'll leave you with this one final thought. The stock market creates some incredible opportunities, but it pretty much always rewards patience way more than impatience. So what's it going to be? Will you choose the patience of sensible decisions or the impatience of chasing the next hot tip? It is time to build wealth slowly, invest wisely, and stay completely disciplined. Thank you so much for joining me for this explainer, and I really hope this helps you build a phenomenally strong investing future.